Yeah, I mean, I think it's somewhat to be expected, and I think we can add another month of that as well. We just released our Black Knight Home Price Index last week, and we saw another month of declines in November. And so I think that is going to be the continuing trend as we move into the early part of next year, given where inventory is at, and more aptly given where affordability is at this point in the market.
So maybe overall a 5, a 10, a 15, a 20% reset. I mean, as we just said, that would still leave us way above pre-pandemic levels.
Yeah, I mean, I think we're going to trend downward into next year for sure, right? If you look at kind of the pace that we're on right now, we'll cross that 0% threshold right around April of next year. And then from that point forward, it's really dependent on a number of different factors, one being interest rates and the second one being inventory, right? That inventory continues to put upward pressure on prices and will limit the amount of decline that we'll see out there in the market.
Limit the decline, and you and I have talked about this, how the housing market might be more in a freeze than falling off a cliff. There's also been some questions, though, about whether the level of foreclosure activity picks up once some of these special pandemic programs end. Could we start to see any pressure points there?
Yeah, and not in the near term, right? So if you look at serious delinquency rate and you look at foreclosure activity taking place in the market, foreclosure inflow is still below pre-pandemic levels. Active foreclosure inventory still below pre-pandemic levels. Now, you are starting to see some uptick in early payment defaults among FHA-type mortgages, which will make their way downstream into that pipeline as we move towards the tail end of next year. You've got some CARES Act provisions that expire as we move into 2022. And so I think the trajectory for foreclosures likely is on the rise here over the next couple of years, but not a massive explosion of foreclosure activity that we saw last time around. We're just simply not in that type of environment.
And we talk about pent-up demand, but demand is weak right now because people aren't really trying to buy. I mean, they're all watching prices. They're kind of waiting. They're watching rates. What would it take to really unlock a wave of demand?
Yeah, I mean, you're absolutely right. If you look at our Optimal Blue rate lock data, there were 50% fewer purchase mortgages locked in November than there were at the same time last year. Simply put, mortgage purchase demand is down 50% from where it was last year. And then you look at where we lost that market, and it was right around the 5% range in terms of 30-year rates. And so I think you're going to see, I mean, we're probably kind of bottoming out in terms of overall purchase demand out there in the market. But to really spur volumes out there, we're going to need to see interest rates certainly below where they are right now. And unfortunately, they're kind of trending in the wrong direction. If you look at 10-year Treasury yields over the last week, they suggest 30-year rates may be pushing higher here in the next week or two. So we're certainly moving in the wrong direction to spur any kind of increased demand.
Yeah, you can imagine if that lasted as we start to head into the spring season, but we won't jump ahead too much. We'll leave it there for now. Andy, thanks as always for your time.